Beginner investors often make the mistake of only investing in their local market and or only investing in the US. This was actually one of the mistakes I used to make back in the day when I had far too much exposure to FTSE 100 stocks and nowhere near enough of the world market.
There is no excuse for this mistake today though, as world diversification can be achieved cheaply and easily. In fact, this can be achieved with just one ETF. But if you want a little more control, then we suggest you consider the 6 ETFs in this video.
If you think it's okay to be invested in just one country, then you should rethink your approach. You absolutely must ensure that you have world exposure. If you are overly exposed to a limited number of markets, then you are at severe risk of being victim of a regional event. Think Brexit, a tsunami, or being at the wrong end of a trade embargo, or even war.
In this video, we're going to be looking at the 6 ETFs that we would add to our portfolio in order to own the world. Let's check it out. Welcome to Money Unshackled, the investment and finance channel that sets you and your finances free. This is Andy, I'm Ben, and if you like what we have to say, hit the like button, click subscribe.
Also, check out the moneyunshackled.com website where we've added a 4-step guide to stock market investing that you can download for free and hundreds of pounds of welcome bonuses that you can snap up if you sign up to one of the investment platforms listed on the offers page. The link is in the description below. Let's get into the video.
Own the world in one ETF. If 6 ETFs sounds like an administrative burden to you, then you will be interested in ETFs that tracks the entire world in one place. Take the Vanguard FTSE All World ETF as an example.
This ETF barely costs a thing at just 0.22% and will get you exposure to over 3,000 stocks in more than 40 countries. It impressively covers more than 90% of the global investable market capitalisation. Now this is a great ETF for those that want to track the world stock markets in a similar proportion as the world stock market capitalisation.
However, this doesn't really spread risk that well at all, as the US dominates the world market, hence why North America makes up 58%. Another strange characteristic of such an ETF is that some companies make up a greater proportion of the fund than some countries. For example, Microsoft makes up 2.2% of the ETF, but India, a country consisting of over 1 billion people, makes up just 1.1% of the ETF. This might be what you want, which is great, but for those that want a little more flexibility, you can construct your own ETF portfolio that covers the entire world in just 6 ETFs, all for a rock bottom cost.
US and North America. It goes without saying that all investors need to invest in the US. If we learned anything from the World ETF that we just talked about, it is that the world stock market is dominated by the US. Apple, Google, Netflix, Amazon, Walmart, McDonald's, these are all household names.
Normally, we would opt for an S&P 500 ETF, but this time we're going with an ETF that also gives us a small position in Canada.
So, our first ETF will be the Vanguard FTSE North American ETF. This one comes in at a low cost of 0.1% and holds almost 700 stocks.
It's a Vanguard ETF, which is our favourite ETF provider. It gives us tons of exposure to some of the world's best brands, including some great positions in technology companies that are now so pivotal in all of our lives.
The United Kingdom. Normally we would suggest a FTSE 100 ETF, but considering we're trying to build a world portfolio in just a handful of ETFs, then this time we will opt for a FTSE All-Share ETF. In this case, it will be the SPDR FTSE UK All-Share ETF.
We like this ETF because it tracks 98% of the market cap of the UK, and this is achieved for a low cost of 0.2%. Yes, you can invest in a FTSE 100 ETF for a much lower price, but this FTSE All Shares ETF will allow you exposure to 600 companies rather than the 100 that you get from a FTSE 100 ETF.
Many of these are smaller companies which tend to outperform larger companies over the long term. The fund's inception date was only in 2018, but if we look at how the index has performed over 5 years, we can see that it has returned 6.79% per year, which isn't bad considering all the Brexit uncertainty.
As UK investors, we feel that you need an exposure to your home country's market because much of what you buy is in pounds sterling. So this acts as a hedge, as many of the company's profits are sterling based. This ETF should track the UK market quite nicely.
Europe excluding UK. We've already got exposure to the UK, but there's also a lot of other great companies in the rest of Europe. One way to invest in Europe is to buy into an ETF such as the Vanguard FTSE Developed Europe ex-UK ETF.
This great ETF holds 475 stocks and costs only 0.1%. It will give you exposure to France, Switzerland, Germany, and so many more. One thing we did note is that even though Europe is filled with enormous companies, we were far less familiar with them than we are with UK and US companies. This ETF will give you exposure to these less frequently talked about gems with no extra effort on your part.
Asia Pacific excluding Japan. Ideally, we would invest in the Asia Pacific region in just one ETF, but unfortunately, it seems that Japan is always stripped out. Probably because Japan is considered so important as it's one of the major stock markets in the world.
There are a lot of ETFs to choose from, but the cheapest we found was the L&G Asia Pacific ex-Japan Equity ETF.
This one costs just 0.1% and invests in Australia, Hong Kong, Singapore and New Zealand. If you're happy to pay a little more, then the Vanguard FTSE Developed Asia Pacific ex-Japan ETF comes in at 0.15%, but also gives you exposure to South Korea, which has some great companies such as Samsung. One of the ETFs that we'll cover later is also invested in South Korea, so you may want to opt for the L&G ETF instead.
Japan. Japan is one of the essential regions in any global portfolio. We can easily and cheaply gain exposure to Japan with one ETF.
Our ETF of choice is the iShares Core MSCI Japan ETF. This beauty comes in at a low cost of 0.15% and has almost 1,300 holdings. It also has a huge $4.8 billion of assets under management, indicating it is very popular amongst investors. You'll get exposure to some huge companies such as Toyota, Sony and SoftBank. You might be familiar with them as they bought our very own ARM holdings back in 2016 for £23 billion.
Emerging markets. And finally, to finish off the portfolio, we need a piece of the emerging economies. These are expected to grow faster than the developed markets, as demonstrated by China in recent years.
Let's go with the iShares Core Emerging Markets ETF. This ETF is invested in an eye-watering 2,500 holdings and comes in at a low cost of just 0.18%. Again, it comes in with a $13.4 billion of assets under management.
You'll get exposure to a host of emerging economies such as China, Taiwan, Korea, India, Brazil, and so many more.
Whilst it might be tempting to invest heavily into this fund, don't forget that these countries can be politically unstable and therefore carry more risk. It's worth being reminded that countries such as Russia can have more geopolitical issues than the developed nations, and therefore this could cause your investments to crash in value.
Portfolio weighting. How much of each of the 6 ETFs should you buy? What proportion? This will depend on your attitude to risk and is not as simple as buying all 6 in equal proportions. The UK, Europe, Asia Pacific, Japan and North America are in all developed nations, and of these, North America is an absolute behemoth. You might therefore want more America than the others. The emerging markets are areas of the world where you might expect more development to occur in the years to come, but more risk.
A moderate portfolio might opt for 35% North America, 20% in the UK, 10% in each of Europe, Asia Pacific and Japan, and the remaining 15% across the emerging markets.
While a riskier portfolio might have 25% North America, 15% in the UK, 10% in each of Europe, Asia Pacific and Japan, and the remaining 30% across the emerging markets. Of course, these are just examples. Question of the day: what do you think of these portfolios we just built, and what allocation would you give to each fund? Let us know in the comments below.
Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.